It's 11 p.m., and you're staring at your restaurant's profit and loss statement, wondering why the numbers say you're profitable, but your bank account says otherwise. You've worked 60 hours this week. Your staff is paid, vendors are knocking, but something doesn't add up. Welcome in. Today, we're breaking down one of the most important documents in any restaurant, the profit and loss statement, or P&L. But we're not reading it like a tax form. We're reading it like an owner. A restaurant can be packed every single night and still be short on cash. It can show a neat profit on paper while quietly losing money through food cost creep, labor mistakes, delivery commissions, missing owner pay, or bad inventory numbers. So in this video, we'll move from the basic structure of a P&L to the mistakes that make it lie, to the systems that rebuild trust, and finally to the weekly decisions that turn numbers into better pricing, staffing, purchasing, and cash flow. The question isn't whether your books look tidy for tax time. The question is, why does your busy restaurant still feel broke? Here's the brutal reality check. Your P&L is supposed to answer one fundamental question. After guests pay you, suppliers bill you, employees clock out, and every fee comes out, is the restaurant actually making money? The bottom line matters, but it is not enough on its own. The real story lives above it. Sales become revenue, but discounts and comps reduce what guests truly paid. Food and beverage costs determine your gross profit, and labor plus operating expenses decide whether anything is left over. In an industry where net margins are incredibly thin, often hovering in the single digits, a full house does not always equal a full bank account. The first owner-level reality check is your prime cost of goods sold plus total labor. For many restaurants, a healthy target zone sits around 55% to 65%, depending on your concept, market, and service model. That's why the P&L matters so much. It connects the dining room, kitchen, payroll, delivery platforms, and cash account into one scoreboard. But here's the dangerous part. What if that scoreboard is giving you the wrong score? So why are so many P&Ls lying to us? The problem isn't malice, it's mismatch. Many restaurant P&Ls are technically complete, but operationally misleading. They look tidy, yet they hide the costs an owner actually lives with every single day. The first major red flag is unpaid owner labor. If you work 60 hours a week, but no market rate salary appears in payroll, that profit number is simply overstated. Another common mistake is labor that looks controlled because payroll taxes and benefits were quietly dumped into a miscellaneous bucket. Food costs can be completely wrong when inventory is copied forward from last month instead of actually counted. Delivery profit gets inflated when only the net bank deposit is booked, hiding commissions running at 15 to 30%, refunds, and platform fees. Gift cards get incorrectly treated as immediate sales revenue, even though they're a liability until the guest walks in and redeems them. And POS sales often fail to reconcile with actual bank deposits, creating timing gaps nobody catches. This creates what I call a bookkeeping black hole, where real costs disappear, phantom profits appear, and restaurant owners make critical decisions based on financial fiction. The problem isn't just bad bookkeeping. The problem is bad decisions made with false confidence. The answer isn't working harder. It's building a system that works for you. Fixing a misleading P&L means rebuilding it from the ground up using repeatable, restaurant-specific systems. Start with your chart of accounts. It should mirror how you actually run your restaurant, not just how a generic business files taxes. Separate dine-in, takeout, delivery, and bar sales so you can see exactly where your money comes from. Do the same for costs. Split food COGS from beverage COGS, separate hourly labor from salaried management, and make payroll taxes and benefits their own visible line items. Show delivery commissions clearly. Don't bury them in generic fees, so the profit leakage is impossible to miss. Then run a monthly close like a sacred checklist. Physically count inventory, post the COGS adjustment, compare theoretical recipe-based usage to actual usage, reconcile your bank and credit cards, match every POS batch to its deposit, reconcile payroll to the general ledger, and correctly book accruals, prepaids, depreciation, and gift card liabilities. Automation tools can help, but they are not magic. Your POS, accounting system, payroll platform, and inventory software still need validated mappings and human eyes checking the totals. Once this foundation is rebuilt, the P&L stops being decorative and starts becoming operational. And when you flip that switch, the numbers start telling a completely different story, one you can actually use. Your clean P&L reveals that your popular pasta dish has a 22% food cost, while your slow-moving salmon actually delivers 60% margin. It shows that Saturday lunch is bleeding labor hours, while Tuesday dinner is your hidden gold mine. You can calculate sales per labor hour and immediately ask whether the schedule was built for yesterday's volume instead of this week's reality. You can see item-level contribution margin, that's price minus food cost, and use menu engineering to identify your stars, your plow horses, your puzzles, and your dogs. You discover that your third-party delivery through one platform is profitable, while another platform is costing you more than $3 per order after all fees. The actual versus theoretical food cost variance catches the line cook over-portioning by 2 ounces per plate, costing you nearly $1,000 last month alone. And most powerfully, you can see the cash flow gap. Profit and cash timing do not always line up, and now you can predict exactly which weeks you'll be tight and adjust accordingly. This isn't just cleaner books, it's operational X-ray vision. Now here's where this gets really powerful. You stop waiting for month end and start running your restaurant from a weekly flash report. Think of it as upgrading from a paper map to a GPS that updates in real time. Do not wait until the end of the month to manage a restaurant that changes every single day. Each Monday morning, you see last week's sales by day part, your prime cost percentage trending, labor variance by shift, and your cash position for the next 13 weeks. When COGS creeps up midweek, you don't guess. You drill into item-level gross profit and discover your chicken supplier raised prices 8% overnight. When labor percentage spikes, you check sales per labor hour and realize you're still staffing for Valentine's Day volume on a quiet Tuesday. You catch portion creep on Wednesday, not the following month. You see delivery commissions claiming 30% of your Thursday sales and immediately shift marketing dollars to your direct order platform. If sales look strong but cash is tight, you inspect delivery fees, debt payments, tax timing, and vendor terms before it becomes a crisis. This transforms your P&L from a historical artifact into a tactical weapon, letting you adjust pricing, prep, purchasing, and staffing while the week is still happening, not after the damage is done. This is the moment everything changes, when your P&L stops being a monthly formality and becomes a living management system with a pulse. We're talking about a paradigm shift from reactive accounting to proactive financial management. A trustworthy restaurant P&L is not just a month-end formality. It is ownership intelligence, clean accounts, consistent inventory counts, accurate payroll, proper owner compensation, correct gift card treatment, and strong POS to bank to accounting reconciliations are what make it real. And this is also where the right help matters. A general bookkeeper may maintain your records. A restaurant-trained bookkeeper builds operational reporting that your managers can actually use day to day. A CPA brings licensure-level tax, compliance, and strategic advisory expertise. The best operators don't just review their P&L, they treat it as the central nervous system of their entire business. They know that a $2 menu price adjustment on Tuesday reshapes their prime cost by Thursday. They've stopped asking what happened last month and started asking what should happen tomorrow. That shift from historical scorekeeper to strategic command center is what separates thriving restaurants from the walking dead. So let's pull this all together. We've journeyed from that late-night moment of confusion staring at a misleading P&L all the way to a place of complete financial clarity and control. Your roadmap is straightforward but powerful. Start with a restaurant-specific chart of accounts that reflects reality, not a generic tax template. Commit to monthly inventory counts that catch portion creep, waste, and theft before they bleed you dry. Reconcile everything, POS to bank, payroll to ledger, sales to deposits, so that timing differences and hidden fees have nowhere to hide. Pay yourself a market rate salary from day one so you truly know whether the business can afford its own leadership. Run weekly flash reports that turn your P&L into a tactical weapon, not a historical artifact. Always watch your prime cost percentage and your 13-week cash flow forecast. When you do this, Your P&L becomes more than a report. It becomes a roadmap to financial freedom. Recognize your menu stars and cut your dogs. Spot rising food costs before they compound. Staff to actual demand, not last season's habits. The restaurants that thrive in the years ahead won't just be the busiest. They'll be the ones that know their numbers cold and act on them fast. Don't just file the numbers, use them. Like and subscribe for more helpful videos like this. Connect with Forks for the experienced accounting professionals your restaurant needs. Details in description below.